and obviously they're still at the very big numbers of close to $72. It'd be worth acknowledging as we kick off the webinar this morning that India recorded the unfortunate data point of the world's record deaths in one day, over 6,000 people yesterday in India. So they sort of follow through of the terrible second, third wave in India is now sort of moving into the horrible data point, which is condolences to everybody there. That's a big thing to handle, and that's probably totally underreported, given that it's generally acknowledged that data points are much lower than actually are. But oil prices down, and the other surprising news overnight is the data point out of the US. Fuel inventories rising while crude declining, but gasoline rising. Let's kick off with our regular Thursday morning commentator, Dr. Carol Knackley, the CEO of Crystal Energy. Carol, good morning. The surprise really that the gasoline consumption in the US less than expected, even though we all saw major traffic in the holiday weekend there. But your thoughts this Thursday morning?
Good morning, Sean. Good morning, everyone. Well, look, I mean, this inventories data a bit increasing here, a bit decreasing there. I think we are by now accustomed to these weekly changes in the data points, but I don't see anything worrying. On the contrary, yes, I mean, things are not back to absolute normal with jet fuels, but remember that the US has just announced that it was easing travel restrictions with respect to a large number of countries. So I think the UK was not lucky enough to be on that list. But and also because we had this kind of high demand driving season, as you said, maybe things have temporarily slowed down, but I don't think this is going to change dramatically the picture for the summer, where things are looking pretty much better. I was looking at the macro picture yesterday and this morning as well, in terms of announcements made that could inject further optimism in markets. I mean, you can see greater confidence coming from the G7 leaders committing to vaccinating 80% of the world population. Yes, not overnight, in the next maybe a year or two, but that's already a positive development for cooperation, because they understand they need to support the rest of the economy. There are also some comforting signs coming out of China. I know the price signals there are not that comforting, but the central bank is saying that this is just a temporary thing because of supply chain bottlenecks. So on balance, I don't look at that data point in inventories to raise concerns, because the direction, the trajectory is there, and for a recovery, hopefully will continue towards the summer. I think it will continue because of the pickup in the travel season.
Ahmed Mehdi, Research Associate at the Oxford Institute for Energy Studies. Ahmed, good morning to London. Do you think, I mean, given, Ahmed, this is a managed supply market, sort of parking that for 1 second, are current prices supported, do you think, by the fundamentals that we're seeing?
Good morning, Sean. So I think just taking a high level view, these data points that you've referred to, I mean, I think growing demand optimism is certainly has been driving the price rally. And obviously, when we look at Q3 and Q4 demand estimates, we see the deficit beginning to widen. Certainly, perhaps not as optimistic as OPEC's view of 2 million barrels a day of that deficit, but certainly even on a conservative basis, that's around about 1.5 million barrels a day. I mean, okay, US refinery runs, they have actually edged higher on the back of the driving season, despite that seasonal build. Despite that the distillate gasoline build. But then you've also got other factors. We've got mobility restrictions, restrictions easing and mobility increasing. Even in India itself, refiners, 2 months ahead are beginning to play a more active role in the spot market. We've got Middle East seasonal power demand beginning to pick up. And then also we're seeing the fact that, both Dubai and Brent are in backwardation. So that's helping incentivize stock draws. And that's also been happening in China as well, and also other hubs. Likewise, when we take into account the supply side, We've obviously seen that the timetable for the return of Iran, which by the way was already priced into the flat price anyway, is actually being deferred, for more likely for Q3 now. So yes, it is justified. And I think just focusing on a single data point, whether it's the current US inventory weekly report, is not probably the right way to do it. So actually on a very high level view, the fact is that from May to August, we're going to see refinery runs ramp up significantly, particularly in west of Suez. So really, that's been supportive, and also, by the way, I would add, it's not just flat price as well. It's also the physical differentials are also beginning to improve, including West African, and also we're seeing very strong activity in Middle East crudes as well.
Let's flip over to the other side of the world and pick up with Peter McGuire, CEO of XM Australia. Good morning, Peter. There's different data points around, Peter, that one might say, are we in a glass half empty week as compared to half full last week? The data point out of China that May oil imports were well down on earlier months in the year. That didn't seem to take too much steam out of this market.
Well, good morning, Sean. No, it certainly did. Another panelist. We're only 50 cents from what we've had as far as the high, I think, for the year. So, you got WTI at 69.50, got Brent at 71.70. So it's strongly bid up. We understand what the point is as far as demand. We understand US dollar index and the overall, I think, appetite from traders to be long crude. And it's been a great trade over the last couple of weeks. So there's been plenty of good money made, hedge funds and certainly retail. Probably a little bit further to go yet, Sean, maybe another $1 or $2 over the next week. I think there's got the capacity to take that out unless you see something dramatic happen with that US dollar with G7 and so on. So that's where we're sitting at the moment. I think it could be over this summer driving season. I'm not going to say you'll hit a 75 handle for Brent, but I wouldn't be surprised to maybe that's the sort of headline that you'll be at by August.
Well, on that point, Peter, is there anything there to stop it rather than what will get it there? Clearly, momentum is underway and has been in the last week since we broke through 70. Is there anything that you might just say, oh, that might stop it getting to 75?
Yeah, I think a couple of points, Sean. What we're seeing in Australia as far as front page news in Murdoch Press, Fauci, so that seems to be a major concern as far as China and the virus. So if that was to really gain some traction, and it's really becoming quite hot here, I'm not sure what the news is where you are or the other panelists, but certainly that noise and that disruption.
Which noise? Sorry, I didn't catch that, Peter.
The noise on Fauci coming from a Chinese lab and those ramifications where as far as penalties imposed on China, if that starts to gain some major traction, Sean, that could derail everything. These markets are they're strong, but I tell you what, they're weak at the same time, and that could be one point. And the other one is those continuing vote counting that you're hearing from the Republicans. So that's what I'm hearing out here. Let's just wait and see what happens. You've got to have an eye on it, but you can't take it off.
Yeah, clearly. And there's also a minor outbreak again of COVID in China, which one has to keep acknowledging is a very unvaccinated country, at least percentage-wise. Carol, we do have the CPI inflation numbers coming out, I think today or tomorrow, for May, likely to be quite high, above 4, maybe even 5%. What are your thoughts on that, and what impact could it have for the markets, do you think?
Yeah, indeed, the data for the US Consumer Price Index, which is a reflection of how inflation is doing, is expected later today. And I'm always trying to understand this kind of thinking that if the market is expecting higher numbers, then why they are not reacting, why they have to wait for the data to be published. But look, I mean, this is something at least the central banks around the world, at least in the major economies, the largest economy in the world, the US, and the largest economic bloc in the world, the EU, there seems to be a synchronization in the message out there that inflationary pressures that you are seeing today today are just transitory and not structural to cause an alarm or reversal in policies. However, that said, we might well start to hear some change in the tone probably after Q3 or in the summer to prepare us for some changes as of early next year. But it's not going to happen overnight. So even if the numbers, let's say, perhaps exceed expectations in terms of the percentages of the increase in the CPI, it doesn't mean it's going to cause the central bank to go and suddenly reverse this policy. We know so far what they are likely to do for the coming few months, but we're going to still read between the lines, listen to the speeches. And even here in the EU, I think they have also the central bank announcement today. We're going to listen to Christine Lagarde's speech to see what she's going to say and try to figure out between the lines what they're going to say. They're not going to say exactly, oh, on the 1st of January, we're going to do this and that, but they might start preparing the market for what is already a natural development, that hopefully by early next year, now that the economy is back almost on its feet, then we might see a revision to the monetary policy, but no, I wouldn't expect any drastic changes now.
The possible even talking of tapering, which we've seen in the past, can really cause wobbles in emerging markets and capital flight leaving as given the divergence of these economies coming out of COVID, that if we start tapering, rate rising in, or even the suggestion of it in the OECD countries, money fleeing out of the emerging markets, forcing them to preempt and raise rates. So the knock-on effect there of this divergence of different experiences coming out of COVID, how big of a factor do you think that will be in the coming months?
Yeah, I mean, definitely you do still have a structural problem here that is the uneven development of economies around the world. But of course, you cannot wait for every single economy to go back to the pre-COVID levels. And there is an acknowledgement, general acknowledgement that most economies are not going to go back to the pre-COVID growth rates before 2022 at the earliest. I mean, you have, okay, the US, China is well ahead of everyone. The US is expected to hit this year, but other economies, even in EU, not before next year. And I was looking at the Middle East, Saudi Arabia, for instance, not before 2023, 2024. So this is just to give you a flavor of the big divergence in terms of economic recovery across the world. But it doesn't mean that's going to hold a central bank from taking rational decisions for next year. Maybe now they are not, as I said, they are not going to make any drastic announcements. They will continue to calm the markets. But at the same time, if you notice these kind of developments, they are being accompanied by more reassuring development, such as, for example, supporting the speeding of vaccination elsewhere. So they are riding several horses at different speeds at the same time. And at the moment, they will stick to their policy, but it will be really foolish to expect the central banks in these major economies to continue with their current policies next year, for example, even if the economy recovers. So there must be, some wisdom in terms of assessing what will happen next. But I'm not expecting any drastic changes for the next at least quarter of this year.
Ahmed, you mentioned in your earlier comment about the Iran talks. Clearly, a lot of the confidence seems to be draining away from an outcome, although they are reconvening today in Vienna, and a lot of people are seeing it as the sort of the last, obviously it is the last chance ahead of the presidential elections. But your thoughts on the outlook for that now that the momentum seems to be slacking for a deal to be done at any stage?
Yeah, so I think that the likelihood of a deal now seems quite slim, primarily because we saw optimism build, and then we saw some sort of pressure on the price, a few weeks ago. But fundamentally, from what I see, this is the last chance. But fundamentally, the difference is not just about reconvening on the JCPOA, but also around all a host of other issues around sanctions and other sanctions, and including Trump imposed sanctions, and also other banking issues and what have you. So, but even if we were to consider the return of Iran, the fact is that the next trading cycles have already completed. So now we've got basically the return of Iran coming, say, even by the third quarter. But as I mentioned earlier, that deficit, can be absorbed. And actually, in any case,
and would we expect to see? Sorry, we saw over the last 6 months a progressive increase in the amount of barrels coming out of Iran.
Exactly.
Is that progressive increase just going to stop growing, or can it continue to get bigger?
Well, as I said, so I think there's a couple of things. One is to do with, well, there's 2 points here. One is to do with, you're right, that there's been that progressive increase, which has, gone up to now averaging about, 800,000 barrels a day, their exports. And that's certainly been inching up from January up to May. Certainly, there's also, in terms of the actual Asian refining appetite to procure Iranian barrels, typically that was done by independent refiners in China who are, under increasing pressure now even. But secondly, also, the issue I don't think is really about crude actually when it comes to Iran, because as I said, it can be absorbed quite easily into the market without too much pressure or too much, considerable unease from OPEC. The issue is perhaps more to do with pressure on condensate, because the buildup of condensate in the Iranian stocks has actually plays an impact on the amount of gas that's supplied into their system, and they have a lot more condensate in storage than they do crude. So that
and there isn't a lot of appetite for that.
And there's a lot of appetite for that, particularly among South Korea. And that would actually impact the economics of NAFTA. And also you have all these increasing capacity coming online in Asia. But also I think the point here is that even if you see a return of Iran, that can be absorbed by the market. And if it is in Q3, then certainly, you've got that relationship going on between crude and condensate, and also some other products as well. And it's all, I think what's missing from the discussion is how this all plays into how the Iranians have been managing their energy system with these different balances. So we're talking about 1 million barrels a day of extra exports, but that would be phased between, say, Q3, Q4.
That could still come if a deal was done, or regardless,
if a deal is done, say, for example, we have the elections in June, and then by the time you have the transition and of power, and everyone's in
the new president would be due to take office in August.
Exactly. So we're talking really, in my view, probably September, October, that some kind of deal is done. But by then, the market, I certainly think that from, July, August, the market will be very tight.
Well, it'd certainly be interesting to see if there's any kind of firm signaling by the time OPEC meet next on July 1st, when they have to make a decision what happens after July 31st. And without knowing where Iran is, that might make that meeting a little bit more complicated. Peter, it's not often we see a headline these days that has the words China and the US agree. And we had one today. The commerce ministers from China and the US agreed to push forward trade and investment talks in their first telephone call since the Biden administration. Your thoughts on that and where that relationship may go now?
Well, naturally, Sean, it's a positive, and that needs to be absorbed by the market. It's a show of good faith. Of course, we've only got to put our mind back, 7 or 8 months ago, and the Trump administration and what their thoughts were as far as China and imposing all sorts of things as far as tariffs. So let's just hope that we see a good news story develop from this. Naturally, both economies need each other due to these common circumstances with COVID. America seems to be reopening in a lot of ways. A lot of their states are performing very, very well, Florida, Texas, and even New York. So it seems to be a groundswell there of positiveness over this Northern Hemisphere summer. And from China's perspective, you made note of that earlier as far as a second wave or a new wave of COVID hitting the nation. So let's hope that they can sort that one out, and it's positive moves up here. The markets are relatively strong. I mean, the only game in town from an economic standpoint, Sean, is equities. The commodity markets are too small, crypto's too wild and woolly, and the bond market, well, that's just a giver of free money. So the situation at the moment is, if we don't see anything dramatic happen as far as taper, I think there's still another 2 to 3 months of good economic cycle to the upside for equities.
We're seeing even the Indian India stock market has been relatively unperturbed by the dramatic events there of the last few months. How significant a factor is the weaker dollar and the outlook for the weaker dollar? Because of course, as we were saying earlier, these emerging markets are now carrying a fairly heavy burden of high commodity prices.
Well, that's it. I mean, I did something with CNBC the other day, and one of the anchors said, well, it's the first time we've had triple digits for gasoline costs or gasoline prices in India. So they're really feeling that in the wallet and the purse across all of the emerging markets with high energy costs and really high commodity costs. Everything's, Sean. So everything's certainly been bid up, from copper to all the base metals, iron ore. You look at the foods and, even stud lumber. So everything's had a very, very solid move to the upside. That in turn really is impacting consumption. Where does it go from here? I still believe that this decade is going to be a strong move for the commodity prices overall. I think that with all of this stimulus that's been wound
we did
into
see
a market,
the Chinese government attempt to try and suppress those commodity prices without too much success, obviously.
Well, no success at all, really. If you're looking at what we experienced with that $225 ton of iron ore on that Singapore, I think that was about a month ago, or maybe 3 weeks, then that was a very, very solid move and very high price. They really haven't had a lot of success, China, and I think the overall demand picture globally is going to remain very, very strong over this next decade.
Let's get the survey question for today before getting the panelists' view to give us some outlook. Brent crude oil to hold above $70 a barrel through June. Agree or disagree? View in the room on where the direction of travel is. Are we locked in now above 70? And it's really more about the upside than the downside. Carol, of course, one of the pillars that we've always talked about from the demand point of view, although this continues to be a managed supply market, but demand is now starting to be quite tangible. We talked about to the US. Where do you see the outlook for Europe is? Because I think that is also, it seems to be a changing sentiment. 1 week it's quite positive, Europe's opening up, everybody's going on holidays. The next week it's actually Portugal shut down.
Yeah, first of all, I have to highlight this terminology of tight market. I find it difficult to see how a market can be tight with OPEC Plus sitting on a spare capacity of more than 5 million barrels a day. So I don't see the two going together in terms of tightness in the market. So that's one aspect. This goes into what.
Well, I'll just share with you my new thesis on that, which I mentioned earlier in the week, and that is that we kind of have to look at the extra barrels in the market, idle supply, a bit like a central bank governor has interest rates in his pocket that he can put up or down, rather than seeing it as idle supply. It's like an interest rate. Each million barrels is 1% or something. But anyway, that's a bit of nonsense.
Let's not go there into that comparison, because you can find lots of loopholes in the thing. But in terms of what's going on in Europe, definitely you see an improvement. First of all, seriously, I think I'm going to have my own radiation trackers, because when you look at the skies in Europe, only a few weeks ago, they were quite clear. You see blue sky and hardly any plane. But today you see quite busy traffic across the skies in Europe, and the data there is out there to support that. So you do have traveling picking up. You do have, let's say, going out and consuming services such as going to restaurants. It's amazing. The cafes and the restaurants are filled up. They require that you show, for example, here in Germany, that you were vaccinated or you have a COVID negative test. But in principle, things look much busier than I would say only a month ago. So in this sense, and again, it has to go hand in hand with the vaccination. So speed up the vaccination, and you see this kind of positive developments happening. So that's why
certainly the case here in Dubai now. It's very much normal to be in a room with 20, 30 other people.
Yeah, and somebody was telling us, a friend told us, even in Russia, where not really a majority of the population has been vaccinated, you still see restaurants busy, because they say that people have developed some antibodies. I don't know, I'm not a scientist, I won't go down that route.
Psychological antibodies, I've had enough.
Vodka.
So overall, things are, supporting demand growth. But again, we have to look at it, piece by piece, because one thing we cannot predict is the virus mutation, and hopefully that will be under control. But yeah, things are definitely improving in Europe, and you can easily see it. You don't have to wait for the data to come out. You can easily see it in normal day-to-day life going around.
Ahmed, picking up on the point Peter made earlier about China and the efforts to suppress the commodity prices there, the China petroleum tax has come in. Your thoughts on that and its implications for the market?
Yeah, just briefly, just quickly to respond to Carol.
Yes.
I think on the point about spare capacity, I mean, it's always made. But that reinforces the point that OPEC is very much in control of this market this year, firstly, because, effectively the numbers from the US have been relatively disappointing, in terms of US rig count.
But which is the bigger surprise, Ahmed? OPEC discipline or US production not coming back?
Well, with US production, there's an interesting debate, in terms of capital discipline. US rig count is around, what is it, 360 or something like that. The issue of high grading portfolio, so it's about productivity, not necessarily counting the rig count. But you can get into a big debate. Nevertheless, the fact remains, it's about what is it, 11.2, 11.3 million barrels, so still very significantly lower than the 2019 levels. So, the fact is tight because the market is drawing inventory, and, we're backwardated. So there's incentives to do that. So once you get to a situation where refiners have to decide as to what they're doing, it gets to a position where OPEC has leverage. So that spare capacity doesn't matter in this market. The fact is it's there, but it's not, there's no incentive to put it back on if it's tight. That range, you have to ask yourself, what is OPEC's sweet spot price? And 70, 75, they can manage that throughout the year. That's not something which at the moment is leading to, typically the conclusion within OPEC meeting rooms was that the short cycle, elasticity of the supply side was a threat when you were at 70, 75. It may come back in 2022 when you have a lower amount of contestable demand, but right now they're in the driving seat. So I think that's an interesting point, which I may be wrong, but certainly it seems to be something which they can add more crude back into this market without impacting too much the flat price. So I think
clearly
that's what makes the market tight, in the months coming
up. Just back with very quickly, just on the China petroleum tax point.
Very quickly, I think the thing that I'll be watching is, June the 12th, it's already having an impact. Really, it requires, a session of its own, but just very briefly, it is a tax on various imports, typically light cycle crude, which comes out of the refinery, and diluted bitumen, which is, which is really masking Venezuelan crude into China. And really, this is just efforts to, pressure is increasing. It always has been. It's not new. Pressure has always been rising on independent refiners. I think the interesting implication here is really that it impacts, the two impacts it will have, I suppose, will be one, what do independent refiners do because it impacts their import quotas? Will they start to procure more fuel oil or even actually heavier crudes? And actually that's lifting and actually supporting some Middle East grades like Iraqi Basra Heavy in the market. But also on the light cycle oil, that typically was coming from South Korea. So actually what it does is that it has about 400,000 barrels of blended diesel supply is set to disappear. So actually gas oil balances in China tighten. So what happens to inventories on gas oil, but also whether or not, state-owned refiners begin to ramp up refinery runs is very interesting. So regardless of the point of, some people have said, well, actually that impacts Chinese demand in the next cycle by the independents procuring less, but it could be offset by other mechanisms, whether it's so it'll be interesting to see what
still to play out. Let's get the survey result and give Peter the last word. Brent crude oil to hold above 70 through June, agree 76%. This is a bullish room this morning. Peter, as you started, the equity markets seem to be back hitting records again. Any reason to see that not continuing the rest of the week into next week?
I think, Sean, it's a recipe for a stock market party. The party's in full swing, man. Let's get the streamers out. This is going to be a strong, I think, June, July, unless something dramatic happens geopolitically. So, yeah, it's probably another 8 or 9 weeks of good growth over this Northern Hemisphere summer.
So this is not a year for sell in May and stay away?
I don't think so, Sean. I think there's still, the taper talks. Yeah, you're talking about Yellen's comments, bonds and interest rate rising. Carol mentioned earlier, we've got those May numbers coming out for inflation, unless that scares the hell out of everyone. But overall, bonds, it's supporting the market. Taper, that's still, a number of months away. Let's see what happens in Cornwall tomorrow and Saturday. Maybe someone leaks something as far as taper or some concern to the G7. But at the moment, Sean, it's onward and upward for equities.
Even Larry Summers seems to have gone quiet for a few weeks. Perhaps he's lost the inflation fight. Thank you, everybody. We'll wrap it up there for this week. Peter in Australia, Ahmed in England, and Dr. Carol Nappe in Germany. Thank you for your time and insights this morning. And thank you, everybody else, for joining us. We'll catch up with you next week, Sunday morning, where it's Week in Review with Christoph Ruhl. All the best.
Thank you.
Thank you very much.